So continuing our journey learning derivatives, we move to part two of derivatives, that's option market. Here we'll be learning more about option market. What's an option? An option is actually a contract that allows an investor to buy or sell an underlying instrument like security. It could be an exchange traded fund or even index at a predetermined price over a certain period of time. Now, buying and selling of option is done on the option market, which trades contracts based on securities. Now, I know this looks little like a jargon. It's just too many words here. But whereas when we actually go practically into the subject, we'll be able to understand it much better. I promise you that we'll have a better understanding as we move ahead. Okay, now let me also try and give you another explanation. An option is a contract which gives the buyer the right, but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specific date, depending on the form of the option. Now again, this is another jargon. Mere understanding English is not so easy, but as we move ahead, we'll be able to make a clear understanding. Now, what do I mean by this? If I have to explain this with a simple cartoon, here are the two people, the buyer and the seller. What does the buyer say? Buyer only says, it's a deal, done. But here you need the seller who says, I will sell you this option for an X price. And then the buyer only has to say, okay, done, deal. So that's an option. Now, as I told you, because it's the right but not the obligation to buy or sell stock at an agreed price or on before a particular date. As we understood futures, there is a particular date, yeah, and a particular price. Here it's about the particular price on a strike. That is the difference on a particular strike price that we are going to learn as we move ahead. Okay, now again, this is not going to be an academic learning, getting into jargons, getting into definitions. This will be more of a practical learning, which whatever we are going to learn is something which you can go back and implement and try straight away in the market. First we understand a call and put. These are the two options available. What do you mean by a call? It gives the option holder the right, but not the obligation to buy shares of stock at an agreed upon price on or before a particular date. What is a put? Put gives an option holder the right, but not an obligation to sell shares of stock at an agreed price upon, on or before a particular date. Now again, this is too much of mixing of English words. Let me tell you, if you are bullish or if you feel the market is going to go, you buy a call option. If you feel that market is going to go down, you actually buy a put option. Again, you're buying, but you're buying a put option. By buying a put option, you expect the markets to go down. By buying a call option, you expect the market to go up. Here, you only have the right, you don't have any obligation. In simple words, whatever premium you are paying, that is the only obligation you have. That is the only loss you have. Beyond that, you do not carry any other risk. So also another concept which you'll be learning, another term is that strike price. We'll be learning a strike price. A strike price is the agreed upon price at which the stock will be bought or sold. The sales, all the sales of the call and the put actually happens at a strike price. I give you a simple example of SBI. Let's take an example of SBI. Currently, if it is trading at 200 rupees, there will be a strike price at 190, 200, 210. So at what strike price you would like to trade is the point. Now, just like futures contract, even options expires on the same day. Both futures and options expire at the same day, at the same point. Again, the settlement is based on the underlying asset price. If it's index, it will be Nifty or Bank Nifty. If it is stock, if those 140 stocks, whatever is the spot price, at that price it will be settled on that particular day. So it will have an expiry date, that is expiration date, which is the last Thursday of every month for stocks and last Thursday for weekly options every week, and the monthly contract, it is the last Thursday of the month. So that will be the expiration date. So now moving on. What did we understand? If my outlook about the market is going up, if the markets I feel are going up, I will buy a call option. If I feel the markets are going down, I'll obviously buy a put option. So based on whatever is your view about the market, you're going to make this decision to buy a call or a put. Yeah. Also, we are learned about shorting in the market. Also, we learned about shorting in the market. That is, going short is actually selling first and then buying later. Normally, everyone knows it. It is a normal phenomenon. We always buy to sell. But here in derivatives, when we come to derivatives, since it's a contract, we learn we can sell first without holding anything, and then we can buy later. If our view on that particular stock is weak, it's going to come down. It's going to be available at much cheaper price. We might decide to sell first and then buy later. So sell to open a contract, buy to close the contract. That is also a possibility. So now when I sell, when I, what does it mean? When I'm actually selling, I'm actually assuring somebody a price. When I'm assuring somebody price, it is just like issuing an insurance. It's like actually somebody who is buying it, I'm actually selling him an insurance. So the basic understanding, if I have to understand, in selling an option, now the sellers are also called as writers of the contract. Now the writing of an instrument, writing of a contract means it's like issuing an insurance to somebody who is actually buying that instrument. Okay. Options, like now buying option or buy call. Okay, what happens here? Let us look at a simple example. A type is actually a call which I'm doing. The strike price is 120. The expiration is 30 days from now. When do I do it? By owning the call option. Yeah, here, when do I buy? When my out. So when do I buy this call option? When my, I expect this by buying at 120, this is likely to go to 135. As explained in the chat above, if I feel this is going to be my view, then I actually take a pickup 120 strike price. Then what happens? By owning the call option will allow you to purchase stock at 120 per share strike price at any time within the next 30 days. That is expired before the expiry date, no matter where the strike price is. So this is our understanding. So also, what happens? When do I buy a put? Now, what option? Or when do I buy actually? When do I buy a put? Now, instead of call, I just reversed it. Everything remains the same. It's only reversal. At 120 rupees, suddenly I develop a view, market view, that it is likely to come down to 100 rupees. The stock price from 120 is likely to come down to 100. I actually buy a strike price. It's a put. I take a strike price of 120 and it is an expiry for 30 days from now. Now, here what happens? By owning the put option, you will be allowed to sell stock at 120 price, strike price, anytime within the next 30 days. That is the expiry day, no matter where the stock price is. So now moving forward, what we really understand is, there are three basic elements of option pricing. So moving forward, we will learn option prices are based on three important elements. The first one is time to expiration. The first element we are going to learn is the time. What do I mean by this term? Now, when I say when an option contract is created, you always have a seller. Now, the seller is actually trying to sell an insurance policy because he's the one who's assuring that, I'm guaranteeing you this price. The buyer is guaranteeing the buyer a price, a particular price. It is as good as issuing an insurance. Now, when you issue an insurance for a period, whatever might be the period, the longer the period here, the longer the calendar period, the more expensive it is. Shorter the calendar period, the less price it is. I'll give you a simple example. If the expiry date is 60 days, if the expiration date is about 60 days, obviously the price is about 500 rupees. I'm just giving you an example. And if the expiry date is about 30, then the price will be something like 250 rupees. In simple terms, if you have to understand it this way, the more time is equivalent to more money. The more time is equivalent to more money. So what does it mean? End of the day, what is it trying to say? Now this is where this graph is most important graph in understanding the option. Now, what do you mean by the time value? First, let's understand what happens to the money. So let us take an example from 90 days. If this is the value of the option, in 90 days, if this is the value of option, as it approaches the 0 day or the expiry, it loses its value completely. So option time value is always, option that is value is decaying with the time. With every day, there is a decay. So whether it is a weekly contract, is a monthly contract or whether it is a quarterly contract, it the value keeps diminishing as it approaches the date of expiry. This, as we go ahead, we will learn more about this. We will understand more about this. So the first element we have understood, that is time value. So the second element which we're going to learn is actually the underlying stock price. What does it mean here? Like here I've given you a simple example. Suppose there is a stock which is currently trading at 125 rupees. At any given point of time, three strike prices, whatever is the highest price or one price moment or the lowest price moment, three further strike prices are created. Example, for a stock which is trading at 100 rupees, every 5 rupees interval, a strike price is created. For some stock which is about 500 or 1000 rupees, every 10 rupees it is created as stock. Like in a Nifty, every 50 rupees actually, there is an index which is there is a strike price which is created for index. So similarly in this, there are strike prices for this stock which is trading at 125, 130, 135, 140 strike prices available. Similarly, 120, 150, and 110 is also available. These are the various stock price available. How do you think the call pricing will be done? How do you think the put pricing will be done? Now let's assume that this is 30 days to expiry. This is, we have 30 days to expiry. Let's look at if it is currently trading at 125. When I look at the call strike price of 130, possibly the price is 2 rupees 50 paise. 135 could be 1 rupee 20 paise, and 140 could be 50 paise. Yeah. Similarly, now we also understand various things. 120 strike price, 115 and 110 strike price will be priced at 7 rupees 50 paise, 11 rupees 25 paise, 15 rupees 50 paise, because already it has some intrinsic value. There is already an intrinsic value. Similarly, it is opposite in terms of puts. Remember, the puts of strike prices which is below the current market price, like 120, 115, 110 are priced at 2 rupee, 1 rupee 25 paise and 50 paise. Just like, it is called out of the money. We are going to come to that actually. Also, whereas deep in the money is something like 130, 135, 140 rupees, which is in the money, yeah, is priced at 7 rupees 50 paise, 11 rupees 25 paise and 15 rupees 50 paise. These are in the money. Now that is what we were trying to understand. Now the strike prices in a call, the price which is above, the strike prices which are above the current market prices are called out of the money. Similarly, here in puts, these are out of the money. Yeah, in the value which is, the strike prices which is below the current market price. Exactly opposite, in the money. If you want to say in the money in the puts, it's actually strike prices which are above. As well, exactly reverse is actually in terms of call. Now, whatever price you are seeing here, 2 rupees 50 paise, 1 rupee 25 paise, you have to multiply it by the lot size. Here, this is, if the lot size is 2000, you have to multiply it 5 rupees into 2000, which is 10,000 rupees as the value. Now, this is how exactly it is calculated. Now, this is how the strike prices are created. We will go to the practical. We will be going to the market. We'll be understanding some of the strike prices, and I'll be explaining it to you again. But what we're trying to understand here is actually a concept. Now that we have understood there are various strike prices, the prices vary, and then what happens if the stock price expires? On the day of expiry, what happens to the value? Let us look at it. Now, what happens here? 125, the closing is also at 125, then the value becomes zero. We can understand that the value becomes zero, and all the strike prices above 125 is zero. Whatever was the price pre-year, it has become zero. Whereas what is the intrinsic value, or whatever is the end value here, even though if you have bought at 7 rupees 50 paise, it's only worth 5 rupees now at the time of expiry, because it is closed at 125. So the strike price 125 minus the price, 120 strike price, sorry, here it is actually whatever is the price currently, 125 is the closing price minus this 5 rupees, that is the intrinsic value. Now, similarly, 115 will be priced at 10 rupees, and subsequently 110 will be 15 rupees. Exactly opposite happens in the put. Can you see this? The value has become zero. The value of all these puts which is below the strike price has become zero, and whatever is in the money, whatever was in the money for the put, is priced now at 5 rupees, 7 rupees 50 paise and 15 rupees 50 paise. That is what is the actual value. So what happens when in the out of the money, it becomes worthless at expiration? It's the same. On either side, it is the same. On either side, it is the same. It becomes worthless after the expiry. Now, whatever is the value, you multiply it. If it's 5 rupees, multiply it by 2000. Actually, it's, this is what you get. You would have paid at 7 rupees 50 paise, but currently it is only worth 5 rupees. That is how the option pricing works. Now, what I want to add here is basically the strike price. When you look at the strike price is nothing but a predetermined price at which the shares, of stocks will be exchanged if in option, if exercised. If it is exercised at this strike price, it will be exercised at these strike prices. So this is the basic understanding. Now let's look at the third element, which is volatility. What do you mean by volatile? Some stocks are highly volatile. Every day there is a 3 to 4% or 5% movement. Some stocks are, hardly any volatile, 0.5% or 0.5% movement, up or down, hardly any movement. So based on the volatility, higher the volatility, sometimes, the magnitude of stock pricing is also, so the magnitude of stock price swings is also important. Higher volatility and lower volatility. When there is a high volatility, the risk to the stock owner, somebody who is issuing, is much higher. The price will be much higher. Higher the volatility, it's going to be more expensive. The options are going to be priced more expensively. So it's going to cost more money with high volatility. So the point what we are trying to make is also, the next point I would like to draw here is about the insurance. Yeah, now between these two, can you look at somebody who is actually very fit, somebody who is very fit, who keeps, eats healthy, who is quite fit, and somebody who is actually, I don't have to tell, the picture is telling everything. Now, who will be paying more for the insurance? Yeah, there is no price for the right answer, but I know we all know the right answer. Definitely, this person will be paying more price for the insurance, right? Yeah, why? Because what is high volatility? What happens when this person is actually not taking care of himself? Yeah, he's a couch. He's sitting on a couch, just eating and then adding a lot of calories. He carries more risk. Whereas somebody who is actually cares about fitness is less volatile in nature. Less volatile in nature. The next, of course, we already discussed. Uh, is volatility predictable? Yes, definitely it is predictable. Is volatility is predicted based on the prediction of the volatility? It is priced. So again, I would like to revisit this and give you the emphasis of uh, option time value decay. Time value decay. Here, what happens when you look at suppose whatever is the price you have paid today, with each day passing, each day it going towards the expiry day, the value of the option comes down. This is known as the time value decay, which we'll be learning in the practical classes. This picture clearly explains as the option approaches the 0 day, approaches the expiry, the value becomes absolutely zero. So the most important concept here is time remaining until expiry. That is most important. Is it 30 days to expire, 60 days to expire? Any contract, that is most important. And we have already visited this. Uh, we have already visited this sheet, right? We have understood the strike price, various strike price, the pricing, the value at the expiry, and how all these are calculated. Basically, how all these are calculated. Now, also the most important is the volatility. Is volatility measurable? Yes, definitely it is measurable. We can actually measure this volatility. Then the most important is, higher the volatility, definitely it is more expensive. The option pricing will definitely be more expensive. And then this we've already visited, right? This we've already understood the concept. Somebody who takes care of himself, eats healthy, does a lot of exercise, is low volatile. Whereas somebody who is not even bothered to take care of his health is highly volatile. Definitely, it is priced high. And volatility is predictable. There are methodologies where we can actually predict this volatility. Okay, based on this, option buying and selling decisions are made. Thank you. We'll be actually taking you through a lot of classes. We'll be actually taking you through a lot of classes in practical sessions where I'll be using a lot of market information, sharing you how this option market works. And I wish you a wonderful trading days ahead. Thank you.